In this video we are going to talk about best dividend growth stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Generally speaking, dividend stocks are corporations that distribute a percentage of their earnings to a specific class of shareholders on a consistent basis. This type of company is often well established, with consistent earnings, and an established track record of redistributing a portion of those earnings to its shareholders. Dividends are distributions that are made to shareholders in the form of cash or extra shares of the company's stock. The majority of dividends are paid out on a quarterly basis, although some are paid out monthly, annually, or even only once in the form of a special dividend in certain circumstances. While dividend stocks are well known for their consistency in paying dividends, in severe economic times, those dividends may be reduced in order to conserve cash reserves. The dividend payout ratio is a valuable metric for investors to use in determining if a company's dividend payments will be sustainable in the long run. The dividend payout ratio is a measure of total dividends divided by net income, which tells investors how much of a company's net income is returned to shareholders in the form of dividends versus how much the company retains to invest in further growth. The dividend payout ratio is calculated by dividing total dividends by net income. If the dividend payout ratio exceeds 100% or is negative, i.e., net income is negative, this implies that the corporation is borrowing money to cover dividend payments. The dividends in these two circumstances are at a higher risk of being reduced than they are in the other. Number 1. Target Corp, ticker, TGT. In terms of yield, Target is the first choice on the list, and it is also one of the lowest yielding options. In today's market, shares pay only 1.4% in dividends. It is important to note, however, that there are 2 points to examine. First and foremost, Target still generates a little higher return than the S&P 500 as a whole, despite the fact that it is a smaller company. In addition, Target's yield has dropped in substantial part as a result of the stock's dramatic increase in value over the past year. Having an issue like that is not a bad thing to have. Because of a big $7 billion digital investment that began in 2017, the corporation has been able to increase its competitiveness in an increasingly e-commerce-centric environment. Customers turned to companies that could manage online food and basic products in 2020, and Target was able to meet their pandemic needs thanks to the investment made previously. Throughout 2021, Target has capitalized on its strong earnings momentum, which has continued to produce impressive quarterly results. Number 2. Greif Inc. Jeff. In terms of size, Greif is the smallest company on this list, yet it is also the most powerful. The packaging materials and containers manufacturer is in the perfect location at the perfect time in the year 2021, according to the company's forecast. As a result of the increase in consumer demand, there has been an increase in demand for all kinds of packaging materials. Compared to the same period in the previous year, Greif recorded a staggering 38% increase in revenue in the latest quarter. Furthermore, earnings exceeded projections by a wide margin. Rising input prices, like as the price of wood pulp, have put some strain on the industry. To counteract these worries, Greif was able to boost prices, which was a success. To summarize, Greif stands to benefit from unprecedented levels of spending by American consumers. It also distributes profits to its shareholders. Jeff stock currently yields 2.6% on a yearly basis. Number 3. ABBV Inc. ABBV. ABBV is a repeat entry on the list of the best dividend stocks, having previously made the cut in both 2019 and 2020. It's not difficult to understand why. ABBV stands out as a one-of-a-kind dividend stock in a market where dividends are hard to come by. One of the best-paying stocks in the healthcare industry, it is a great investment. ABBV is unique in that Humira is the product from which the company derives the majority of its sales and profits. In fact, that medicine has been the best-selling pharmaceutical product on the market for the past several years. Bears will point to the company's potential for loss of market share once Humira's patent expires in a couple of years. In order to diversify, the company acquired the rights to other medications, such as Botox, which allowed it to flourish. Shares are currently yielding 4.8%, and given that the stock isn't expected to rise significantly in value in 2021, this could be a good time to buy. Number 4. Johnson & Johnson, J&J. Among blue-chip stocks, Johnson & Johnson is the archetypal example. Every year, the company's revenue and earnings tend to grow by a small percentage. The company is able to pay a larger dividend to its stockholders year after year because of its consistent growth. Moreover, it has now increased its payout for 58 consecutive years, making it one of the few American dividend kings, or stocks that have increased their payout for at least 50 consecutive years, on the market. J&J accomplishes this by operating a massively diversified healthcare company under one corporate umbrella. In the consumer business, products ranging from Listerine and Tylenol to Pepcid and Band-Aids are sold, among other products. Pharmaceutical medications are the company's most profitable sector, although it also distributes medical devices. As a result of the epidemic, hospitals will be unable to perform elective procedures in 2020. With that headwind no longer present, the company will be back on track in 2021, making it an excellent time to invest in the 2.6% dividend yield it is currently paying out. Number 5. Iron Mountain Inc., IRM. In the world of document and data storage and security, Iron Mountain is known as a real estate investment trust, or REIT for short. The company had been in a downward spiral for some time because investors were concerned that a reduction in the use of paper documents would harm the company's bottom line. Managers have, on the other hand, changed their approach by concentrating more on digital services such as data backups and data center operations. In any case, Iron Mountain shares have recovered from their recent decline and are on track to set new highs in 2021. In the meantime, the corporation continues to reward shareholders with a dividend yield of 5.2%. Part of the reason for this is the REIT structure. Because of their legal structure, real estate investment trusts, REITs, are able to avoid double taxation on their income, yet they are required to distribute at least 90% of their profits to shareholders. That has proven to be a mutually beneficial agreement for Iron Mountain stockholders. Number 6. Discover Financial Services, DFS. Since it is one of the highest-yielding credit card issuers, Discover has earned a spot on the greatest dividends list. While MasterCard Inc., MA, gives a dividend return of only 0.5%, slightly higher than the rate on an average bank savings account, it is the most profitable company in the world. Find out more about Discover shares and how they can help you grow your money. With this strategy in place, Discover maintains a very low payout ratio of 20% in relation to its earnings, allowing the business ample of room to increase its dividend in the future. Having exposure to the credit card industry right now is a tremendous opportunity. In response to the flu epidemic, the government and the Federal Reserve provided an unprecedented level of economic stimulation. Consumption has increased as a result of this. People are beginning to appreciate the finer things in life, which has resulted in an increase in the buying of appliances, household goods, travel, and experiences in the year 2021. Because of this, Discover and its competitors have seen a significant increase in profits. Discover shares are trading at only 8.8 times projected earnings. Number 7. Mondelez International Inc., MDLZ. There are a number of food and beverage companies represented on this list, including PepsiCo. As well as these companies, there is Mondelez, which produces numerous household names such as Oreos and Toblerones, as well as Halls, Trident and Tang. In 2020, sales increased significantly as a result of the epidemic, which caused people to stock up on food for their households. As the benefits of the tax cut fade and inflationary pressures grow on the cost side, stocks have begun to decline in 2021. A food behemoth such as Mondelez will, on the other hand, be able to force through price hikes and emerge from this difficult period stronger than ever. The stock has only gained a small amount over the past year, making this a good buy. Meanwhile, the company is providing a fair dividend of 2.3%. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.